Smith, financial literacy expert and poet. Farley Flex, social activist and entertainment trailblazer. And Roderick Brereton, social entrepreneur and conflict management specialist.
Now we're back to where we were supposed to be. So good morning and a happy good morning to everybody joining us. This is Flip, Floss, and Fly. I believe this is our 9th edition. So we are making headway. Throughout the journey thus far, we've covered several topics and we've had amazing feedback and amazing attendance and responses from everybody here with us. So today, Andre, what are we having today?
So today we actually have quite a bit of exciting things on the agenda. We're going to be continuing with the previous discussion. I actually included a segment in this week's discussion called Flashback Saturday, right? And we're going to see what that segment is about. We will also have some speakers, one or two speakers joining us to talk about insurance today, right? So lots of exciting things. And before we get started, I think everyone knows the routine by now that we need to make sure that everybody is Irie in the house. And just a quick check-in with your Irie before we go forward. Can I get some Irie?
Big up to Judith for saying she was Irie. The first person to say she was Irie today was Judith.
All right, Judith. Big up yourself.
All right.
All right, so let me just get my presentation up here. Before I get into the discussion, and I know everybody's feeling Irie, I actually want to give, I know this is not a political forum, but I want to give a big shout out to Kamala Harris for being named the VP, right? The VP of the United States, of the running with Joe Biden, right? So, she is half Jamaican, she's Indian Jamaican, and so that is very exciting to see a woman of color potentially going into the White House. So can I get some Irie times 2? I want you to put Irie times 2 in the chat for Kamala Harris.
And the Jamaican, full Jamaican.
That means the roti is gonna be nice,
right? We're gonna go to the White House and change up the menu. Oxtail and roti on the menu.
Jerk roti.
But this time we want the beta pack curry. We don't like the other one.
Okay. So for those joining for the first time, thanks for coming and thanks for participating. I know it's not easy to get up on a Saturday, so we appreciate that, and we appreciate everyone who's been with us from the get-go. Right? It's week 9, as Roderick said. It's 9 great weeks. We've had some amazing discussion and some amazing insight. I actually have people who participated in these sessions connecting with me one-on-one to talk about different things, right? I just had a one-hour conversation with a participant from this session. It was an amazing discussion. We weren't even talking specifically about financial literacy. We were just talking about the Black community in general and how we need to work together to build the community, right? So I really like what is going on. And again, big shout out to Nadine Spencer, Farley Flex, and Roderick Brereton for the work that they're doing, the BBPA, Urban Res. Can I get a shout out? It's week 9 and we have to keep it spicy, right? How you like a jerk chicken? You like a jerk chicken spicy. And that's why I like my webinar, spicy. So we're gonna keep it that way. So my name is Andre Smith again, and I'm from Jamaica. I went to York University, did my undergraduate degree at York in accounting. I'm the founder of FLIP and Floss, which is an acronym for Financial Literacy and Investor Program and Future Leaders Obtaining Sufficient Skills. I also have a part-time tax and consulting business that I do from time to time. This year, because of my work around financial literacy, I was awarded the 2020 Canadian Broadcasting Commission Community Champion Award, right? So the competition was intense. And again, I was selected for the work that I'm doing around financial literacy, right? This is a very important topic And I am very, very excited and grateful that I was given the platform to talk about financial literacy. All right. So please engage, ask questions, and let's have another fun and engaging Saturday. So up top, week 9, flip, floss, and fly. This week, like the other weeks, we're gonna have our trivia question. So the rule is you must come on the screen. You must unmute your microphone and answer the question so that we can hear your beautiful and talented voice. And if this week we wanted to shout out where you're from, right? Because we know we have participants from across the GTA as well as in Ottawa and Montreal, etc. So shout out where you're participating from. So this week's trivia question. Hold on.
Andre, is it a requirement to also show your face or not?
Yes, if you can show your beautiful face as well, that would be great. All right, so this week's trivia question is, what is a will? Please explain the following concepts, an executor and a settler. So the first part is, what is a will? And explain these two concepts. And remember, the prize is a $25 gift card. So once you win that prize, please send your information in the chat for the prize to be sent to you.
That's a postgraduate question.
Well, we have a bunch of postgraduate people here.
You've got a response coming.
Okay.
Can I answer? I don't know. Can you hear me?
Yes,
Yeah,
we can
hear you.
Okay. I know that a will is before you die or when you're sick, you write it down so everything that you have, money, house, car, you decide to whom it's gonna go. You know, your family, your friends, an organism. You write it down, or you go see your I forgot the word, but you go see that guy or that woman and you give them the paper and you do it together and then you write down your will. And that's what I know.
Okay.
And an executor or a settler, I don't know which one is which, but I know one of the other is the person that has the will, and that once you die or for whatever reason you have to execute the will, they're the ones that are going to call on the family and everybody and be like, this is what you have, this is what you have, this is what you have, this is what you have. And I think the other person is, well, the person that receives the money or the car or whatever from the will.
All right, and where are you participating from, Monica?
I'm participating from Gatineau, so
Nice.
It's next to Ottawa.
All right.
Awesome.
Quebec
From
in the
Quebec,
house.
yeah.
Quebec.
All right.
Nice, good stuff.
Amazing.
Beautiful.
All right. Beautiful. So thanks for that that explanation. So you are, I would say, mostly correct, but you're still gonna get the prize because we are not about right and wrong. We're about those who are effort. Exactly. So yes, you are right in the will, in terms of the will and the executor. The settler is it's similar to the executor. It's just that the settler deals with trust, right? So they are the person who executes the trust, right? So they very similar role. The executor deals with the will, and the settler deals with the trust. Okay, so very similar. So thank you so much, Monica.
I have a question. When you say trust, what's the difference? Like, is it trust? Is it objects and not money, or what's the trust?
So all right. So a will, just like you said, it's a legal document that lists all your assets and liabilities and who gets what. That it stays with the individual. A trust is almost like an entity you're setting up, right? It's a legal entity by itself, and it's treated separately than an individual, right? You are holding, which I'm going to explain in a nice flow chart later on, is like you're moving all your assets into this trust to hold them for a particular period of time. So let's say you have a kid that's like 5 years old, and you want to hold those assets in the trust until that kid is, let's say, 18 or 21. You set up a trust, which is a separate entity, right? Which is different from a will. The will is just a document, and a legal document that tells how the funds our assets are divided, whereas a trust is a separate legal entity. All right, so that's really the key distinction, and I'll show you that flow chart later on. Okay. So,
Thank you.
Marlene, I know, please don't think I forget. I'm not that forgetful. You have you also you have a homework to present this week. So Marlene, can you tell us if you did that homework? So
Yes,
everyone
I
who's
did.
participating. So Marlene's homework, last week she asked about implementing what we talked about. And so I assigned to her to go through all her assets and liabilities and then come to us today and tell us that she did.
Yes, I did.
Okay. And how was that exercise?
Gruesome.
All right.
Was it the outcome that was gruesome or the process?
The process, I will admit that gruesome. It was painfully necessary, and it forced me to think. And when I wrote down stuff, I said, well, I didn't even know I had this. I even have songs. Can I tell you, I have songs that I wrote, sheet music that in trust that when I told my kids, they have to sing it. They have to invest, I have it that pattern, and it's from my life experience. Each stage of my life, this happens, and I verbalize it through music. So that was, when you told us that we have stuff that we don't even know we possess.
Mm-hmm.
And so that leads me to, and Andre and I outreach to him in the week for some advice on how to leave some stuff for the grandchildren, right, Andre? So
yes,
I'm executing. So thank you for that. To
no
raise
problem.
my awareness, yeah, and how valuable we are as parents and grandparents.
Can I get some Irish for Marlene? Thank you so much, Marlene, for sharing, and thanks for doing that assignment there. So this is what we want. We want to see more implementation. And even if you didn't get a homework, feel free to come forward and tell us how you've implemented something from the discussion in your day-to-day routine, okay? All right, so we're getting some Irish there on your behalf, Marlene. All right, so we're going to continue with the discussion. So again, we're at week 9 and we're talking about wills, insurance, and estate planning. All right, so because we're talking about investment and the management of assets, it's important for us to have a disclaimer. So I'm going to just read this disclaimer to you quickly. This presentation is not, and nothing in it should be construed as, an offer, invitation, or recommendation in respect of a company's credit facilities or any of a company's securities, or an offer, invitation, or recommendation to sell, or a solicitation of an offer to buy the facilities or any of a company's securities in any jurisdiction. Neither this presentation nor anything in it shall form the basis of any contract or commitment. This presentation is not intended to be relied upon as advice to investors or potential investors and does not take into account the investment objectives, financial situation, or needs of any investor. All investors should consider such factors in consultation with a professional advisor of their choosing when deciding on an investment, if an investment is appropriate. By participating in this session, attendees agree to indemnify and hold harmless Andre Smith, aka Flip and Floss, Easy Solutions Tax and Consulting Services, the BBPA, Urban Res, the estate of Donald Reid, and all its partners from any and all liabilities and proceeding. AKA, don't come after me. All right. All right. So let's go into the discussion. All right. So this Saturday, and I throw in this segment because we're in week 9, and I know by now people probably forget some of the things that we talked about in week 1 or week 3. So I built in this segment called Flashback Saturday, right? And I have about 5 or 6 questions here, and I need one person to come on live, state your name and where you're participating from, and answer any one of these questions, all right? And you can tell us how, I think one of the questions is, please tell me what is the most impactful thing you've learned from this program and how you will apply it going forward. So even though this is one of the questions, multiple people can answer this over and over, all right? So let's see who's gonna go first.
And just to recall, the word of the day, or this is the second week of challenge. So you got to challenge yourself to come outside of that comfort zone, take a chance, and just build capacity within yourselves and everybody else who's on the Zoom, and also within your community. So challenge yourself. Don't stop. You want to repeat the question one more time, Andre?
Sure. So please come on. So unmute yourself, turn on your video, and state your name, where you're participating from, and answer any of these questions here. So the first question is, what is a credit score? Provide 2 factors that affect your credit score. So feel free to answer any of these questions, right? So again, unmute, turn on your video, state your name and where you're participating from.
I can start it off. My name is Keisha from Newmarket. And
Nice.
the question is, what is your credit score? Your credit score is what states your assets, like all your assets and how you pay back things. And it's like a report of your ability to pay back debt. And something that affects it is, yeah, your ability to pay back debt, your mortgage and how you pay back your mortgage. What I've learned is so much stuff. I think the most important for me was like the mortgage things, like your ability to get mortgages and how you can kind of like use a TFSA kind of thing to like help you like build up your credit to help you get be able to get mortgage. And then I also learned that if you have like a credit card for a long time, you shouldn't just cut it off. You should just keep it and maybe just like cut it up and not use it, because you want to keep that history, that report, because then they look back to see how long you've had a credit like history for. So yeah, that's what I've learned.
Good stuff. Thank you so much.
Very nicely done,
amazing.
Keisha.
Yeah.
Big up, big up.
Big up yourself. See, we have some more chat here. So anyone else? Remember, challenge yourself to get out of your comfort zone.
No.
All right, let me be straight up. I'm not going forward until I get more participation. I'm not gonna say it nicely. Come on, Lion, please.
We got JS on,
JS.
on with us too.
What is it, JS? What is it, JS? I can't see it.
Hi,
Hi, JS. How are you today?
my name is Jaden. Like, that's just my initials.
All right, Jaden. Hey, what's going on, young man?
And I could answer. Oh, and I'm from Ontario, Canada.
Okay.
What city, Jaden?
Brampton.
Brampton.
All right,
in the house. All right.
And I could answer the question to provide 2 factors that affect your credit score.
Okay.
That could affect it. To make it go lower is not paying your bills, like paying your like rent, for example.
Okay.
Yeah, and also other things too, like your car, like not paying for your car. And
okay.
Yeah.
Good
All
stuff.
right. So
thank you,
how is
Jaden
this?
from Brampton.
A quick question for Jaden. How is what you learned here on Flip, Floss, and Fly going to impact you as you get older? For instance, when you get a house and when you get a car.
From what I've learned more about mortgage in the past couple of weeks I've been here.
Okay.
I've learned about mortgage. I wrote it all down.
Amazing.
Good. That's the way to do it.
And might I add that Jaden has a business. So Jaden has a business, everyone. So that's amazing.
Yeah.
Excellent. All right, Jaden, we're proud of you, young man. And make sure that you tell a friend to join us here every morning, every Saturday morning on Flip, Floss, and Fly. And also, whatever you learn, please share it with your friends and your family, okay?
Yeah, for sure.
The nice thing about knowledge, Jaden, is it's not like a material object. When you share it, it multiplies. It doesn't divide. Okay, so try to remember that. And I also encourage you to go to sayitloudcanada.com and look at the opportunities there for young entrepreneurs like yourself.
Thank you. Yeah, I will for sure.
Yes, so make sure you write that down too. How old are you, Jaden?
I'm 12.
Beautiful.
All right,
Wow,
excellent.
that's amazing. Congrats, Jaden.
Thank you.
All right, and anyone else?
I actually have an addition question from experience for Jaden, where like I'm concerned. I'm just new to the the program and everything.
Welcome.
And I'm interested on the financial part. I'm interested in the business part because I am myself is building my own business.
Great.
I'm from Toronto, Ontario. But in terms of, I would like to get a bit of more understanding in that. And then of any other avenues to start, like to get support, financial support, how to balance. Okay, my question is how to balance my finances in renting my own home and also, eventually having a car and also right now business, like how to balance business and rent and all that stuff. So that's what I would like to know more of because like I said, I'm new to this. I have a strong interest to get more information about finances and develop myself.
Great. Well, can you walk folks through how to go look at the past recordings, right?
Okay, yes.
Because a lot of people are asking that.
Okay, if you go onto the BBPA website, and that is bbpa.org, and you go to /programs/videos, you can see the sessions that we had in the past online. Also, to get more information, and we're commending you for entering the business world and challenging yourself to take that leap, which is amazing. You can also contact the BBPA in terms of becoming a member, and all of those services that you just spoke about will be available to you in terms of helping you set up your business, helping you manage the balance that you're referring to also, and also looking at different opportunities for you in terms of procurement, in terms of, when there is partners or networking opportunities that you can help propel your business. So that's what the BBPA, the Black Business Professional Association, is here to do. And we've been in service for the last 38 years, and we've been helping Black business owners like yourself and Black professionals in terms of their trajectory and in terms of reaching their goals. So please do join us there, and somebody will be happy to speak to you. And I'll put down the phone number in the chat so that you can contact the BBPA if you just needed to talk. Okay?
And then on my other note of question, I have I asked someone the other day because I was in another financial workshop from Credit Canada Debt Solutions. I don't know if you heard of it.
Yeah, I've heard.
But I've been doing a lot of research in terms of okay, eventually when I do have a family, or if a person has a family, what can you encourage young people or young adults that are single, that are on their own, how to prep for a family and to budget and save and to build themselves, or to also eventually have a home? How can you, what is your advice to that, especially if you're gonna go through the dating stage? Because finances, when you do weddings, it's a big expense. When you buy a home, it's a big expense. So what can you give me as an advice for myself? I'm not thinking about it, but in the near future, I believe it's always very important to prep yourself.
Well, you say you're not thinking about it. What you actually need to do is start thinking about it. And you actually hit a very important point there is budgeting. For me, I like to tell people in their budget to forecast. So here's your thing. There are multiple events that you're thinking about. So one is a wedding. The other one is starting a family, right? And then there are other events that you're thinking about doing. So, it's important that you plan for each of these events and look at them in totality to see how they affect your overall financial situation. And so budgeting is going to be very key, right? So you need to have a budget in terms of your current income and current expenses, right? And then you have to see plan for the timeline for these other events. So, okay, are you gonna get married before starting a family? Are you gonna start a family, then get married, right? And then you have to kind of plan for the costs associated with each of these. Because part of the important thing and why a lot of people tend to struggle is that people like to get multiple things done at the same time and big events. So for example, I come and I buy a house today by next month I get a car, I take out all these furniture without properly assessing if financially I'm able to manage all of these things at once, right? So the two most important things that I'll tell you: one, start thinking about it. Two, budget and plan for each of these events well in advance, right? And make sure that you are spaced in the timeline to give yourself enough time to recover from each of these events or plan appropriately for each of these events.
And like with the stage that I'm at right now, so it's very also important to save, and then also to with the debt thing. Like for me, for example, I know myself, I'm working on recovering some debts.
Mm-hmm.
It wasn't bad like a couple years ago, but now it's kind of decreasing. What could you say in terms of rebuilding my credit and getting myself out of debt?
Mm-hmm. So the first thing, and that's good that you've brought your debt down. Congrats. Definitely, you want to bring the debt down as much as possible, right? And keep it that way. Don't incur debt. In terms of your credit, the first thing that I'll do is to request, so you can get a free copy of your credit report, right? So that's free. If you actually want the score, there are platforms that give you the free credit score that you can, just Google free credit score Canada and see what your score is. The next step is that you actually want to figure out what is impacting your credit score. So if it is that it's late payment that's affecting your credit score, then perhaps you need to make sure that you're making your payments on time. If it is that you're going to have a late payment, the most important thing is to reach out to the lender to say, hey, I'm unable to make my payment in the 30-day period. Please don't report or whatever. But you definitely need to figure out what are the things that are impacting your credit score. If it is a collection that's affecting your credit score, you need to address the collection. So you need to pay it off. Most, if not all, financial institutions won't give you additional credit with an active collection. Sometimes collections are mistake. Sometimes they are legitimate. If it is a mistake, there's a process to get that removed from your credit report, right? So that's the first step that I would suggest, is to get a copy of your credit report and see what is impacting your credit score negatively.
Okay, thank you very much.
No problem.
All right.
All right.
So let's keep it moving there, folks.
All right, let's keep going. All right. So the objectives for today, just two overall objectives. So have a basic, should be basic, have a basic understanding of the tax impact on trust and beneficiaries. And I'm going to talk about what a trust is again and who are beneficiaries. Have a basic understanding of the different types of insurance products available. All right. So this is the flow chart that I spoke about earlier, and I really wanted to put in a synopsis what the process or a trust looks like, right? So this is the pretty much the 4 stages in setting up a trust, right? So the first person in the trust is the settler. So this is a person who owns the asset. So this is Marlene. She went and she's gone through all of her assets. So she's the settler in this scenario, and she's transferring the ownership of the property to a trustee, right? So this is a person who is a trusted individual. It could be a legal representative or an organization, and they're going to hold title to the transferred property. So Marlene, she's gone through all of her assets, and she said, okay, trustee, I'm giving you these assets, right, to hold on my behalf and to manage my trust, right? So this trustee now manages the trust. So we have the trust right here in the middle, this green triangle here. So a trust, just like we talked about last week, under the Canadian Income Tax Act, the trust is a separate legal entity, right? That means that it's taxed separately than the individual who owns the trust, okay? So once we establish that trust, now we need to decide who are the beneficiaries. So the beneficiaries, just like Marlene gave in our example, so it would be our kids and our grandkids, probably siblings, right? So you're gonna decide who you're gonna give what portion of the trust. So these individual receives the benefit of the property, right? They may receive income or capital gains. And as we've talked about, I believe it's in like week 3 or 4, so capital gains is the appreciation of a capital property, such as a house. So if you bought a house for $500,000 and the price goes up to $700,000, that $200,000 difference is considered to be capital gains. Any question here regarding the flow chart for a trust and some of the key concepts? Okay, so in a nutshell, this is really what we talked about the last time in terms of trust. We also spoke about a will. So a will is a legal document that really lists all the assets and the liabilities of an individual, right? And you know, for a will, we appoint what we call an executor. So that executor can be a legal representative, or it could just be a friend or a family member that you trust. The most important part is trust, right? As well, we need to make sure that the executor knows exactly where the will is, because it's the original document that will be needed when it goes to court to divide those assets, okay? If that original document cannot be found, then it's almost as if there is no will, okay? All right, so
that being said, Andre, and I know this has come up a few times in my lifetime where I've seen it or heard it. So people cannot find the will, or you know, they've misplaced it or whatnot. So that being said, I think it's always important to put a will in a safe place, like a safety deposit box, so that in the event that you need to find it, it's right where you know, and also have more than one person know where it is.
Know where it is, yeah.
In the event that you need to access it.
That's a good point, Rod, and that begs the question: Andre, is it wise to have more than one copy of your will? So that hypothetically, if you have multiple children, 3 children, let's say, and you create your will, you create 3 copies in total and give each of them one.
Well, yeah, definitely. What I would say is, I probably wouldn't give it directly to the kids. I'd probably, you can appoint more than one executor, right? So you can have executor 1 who's a primary executor, then you can have like 2 additional executors. So you can have those 3 copies and give it to each of those, because you don't want a scenario where, you know, those kids, 1 or 2 of them being malicious and trying to destroy the will. So you can have multiple executors, but 1 being the primary, and you give each of them a copy.
Okay.
So good point there, Farley and Roderick. And another thing too is, we talked about this last time, is a power of attorney, right? So if it is that you are incapable of creating a will or making certain decisions, you can appoint a power of attorney, who is a person who you give the legal permission to make decisions on your behalf, okay? All right, so we're going to talk about the tax impact of a trust, right? So computation of income. So big word there. Computation really just means adding and subtracting income and expenses. So for tax purposes, the Income Tax Act, also referred to as the ITA, treats a trust as if it's a separate taxpayer, right? So in Canada, there are 3 taxpayers. So the first one is an individual, you and I. The other one is a corporation, which is a business. And then there is a trust and will. All right, so this is a third taxpayer for tax purposes. So what does this mean? This means that income can be taxed in the hands of the trust or in the hands of the beneficiary. So hands here is not literally your hands, it just means that wherever the income is earned. All right, so if the income is earned in the trust, there are special tax rules for how that amount is taxed, right? Or the amount can be taxed when it's passed on to the beneficiary. And I'm going to go through 2 scenarios or types of income that is taxed in the hands of the beneficiary in the next slide. Any question regarding what I just said? Any questions? All right. I know tax can be...
I had a question. I just didn't unmute myself quickly enough. When you say tax can be taken away from the trust, that means that like every single August you have to make I only know the word in French, but do you have to make that sheet of paper that's like, this is how many taxes I have to pay, like if you add money onto it? Or is it just when you add money onto it, tax gets taken away from that and then the government never touches anymore? Like,
and that's a good question. Hold that thought. I'm actually going to answer that question in a couple of slides down.
Oh, okay.
All right. Very good question.
What is the word in French? Say the word in French.
Tu dois faire tes impôts. Like you just, and then that's considered just doing the sheet and everything.
Okay.
All right, thanks for that.
Rod is learning French. I wanted you to say that because Rod is learning French.
Yes, she mean income tax, to do income tax.
Yeah.
Because she was talking about the taxes.
Yeah. Sorry, Antonia?
So I think you meant April, not August.
Yes, we do the income tax in March normally, no?
Well, March 4, yeah, it's due April. Yeah, exactly.
It's due April 15 for individuals. Yeah.
Right.
And if you're a corporation, it's due 6 months after your year end. That the filing is due 6 months after year end. The balance due is 2 months. So if you owe the government, it's due 2 months after year end. All right. So overview of estate taxes. What are the tax impact on a beneficiary, right? So this is something that you have to think about, especially when you're doing your estate planning, right? You have to think about how the government is gonna tax you. And I think last week, Farley made the joke that when we were saying, oh, the two most certain things is debt and taxes, and then Farley was saying being black as well. But yeah, we have to think about the taxes, right? So we have to think about the tax when we are thinking about transferring assets to our kids or siblings, right? So income of a trust in Canada that is paid or payable to a beneficiary is included in the beneficiary's income. So a mouthful there, I'll break that down. So the first part is that income of a trust resident in Canada. So in Canada, you are taxed based on your residency. So there's actually a criteria in the Income Tax Act that walks you through what it takes to be a resident in Canada. So for example, the government will look at where you have your house, where you have your job, where everything is. If it is in Canada, then you might be deemed to be a resident, right? So it's a similar thing with a trust. You know, the trust can have a different residence. So even though the kids are physically here in Canada, where the trust is set up, it can be another country. And in that scenario, the tax rules would be different, right? But I won't go into that because that would be a very complicated discussion. So that's the first part about why it says a trust resident in Canada. The second part to the first bullet is that it's paid or payable, right? So paid obviously means that the beneficiary already received payment. Payable means that at some point in the future, an amount will be paid over to the beneficiary. And beneficiary, again, is the individual or individuals receiving the income. All right, are we okay with that first bullet point? So there will be some tax impact on that person receiving the income. Now, generally, so in Canada, we have different tax brackets, right? So if I'm an individual who is in the second tax bracket and my marginal rate is about 43%, if this trust pays over income to me, I will be taxed at 43%. So that's really what that first bullet is saying, that you'll be taxed, it will be included in your income. So if I got $500,000 from this trust, it will be added to my income and I would be taxed at whatever my rate is, right? That's in a nutshell. It can get more complicated and there are ways that you can deal with those taxes and differ those taxes, right? So you can, you don't want to take, I know especially in our community, we like to get the cash up front, but I'll tell you, taking the cash up front can have serious tax consequence. So you always want to plan to make sure you're taking it over a period of time and in different ways when your tax scenario changes, right? And another scenario is that the income could potentially flow tax-free to the beneficiary because it was already taxed in the hands of the corporation. Sorry, in the hands of the trust. So remember the previous slide, I said it could be taxed in the hands of the trust. So if the trust already paid taxes on that income or capital gains, then it could potentially go to the beneficiary without any additional taxes, right? So those are the two scenarios to think about when you're thinking about the potential tax impact on the beneficiary. Any questions regarding what I just said? I want to make sure that we are clear in terms of the tax impact. All right, and so this is what Monica was asking. So does this mean that I would have to pay the government a certain amount of money at a specific time? So the answer to that is yes, and that is called the 21-year rule. So every 21 years, your personal trust is subject to taxes. So in Canada, the government has what is called a deemed disposition. And I'll explain to you what a deemed disposition is. So this is where the government assumes that you sell a particular property, whether you sell it or not. So you don't have to literally sell it. I'll give you an example. If I own a house today that I bought for $400,000, and let's say 5 years down the line, I pass away. In that scenario, the government deems that I sold the house 5 years later, right, upon death, right? So there's a deemed disposition. So that's when the government, under certain circumstances, assume that you sell the property. It doesn't mean that you actually sell the property, right? So in trust, this is one of those scenarios where every 21 years, there's a deemed disposition. So let's say you you have a kid that's 1 or 2, and you created a trust, right? And you say, okay, you want this money to stay in the trust until this kid is 21 or 22. So after 21 years, the government is going to take a look at the value of the trust. So let's say you bought some stocks that worth $100,000. After 21 years, if that becomes $1 million, then there is a deemed disposition at 21 years. And so now you would have to, it's subject to taxes, meaning that the government would need a portion of that additional $900,000 that you made in capital gains, right? So that's the 21-year rule. There are ways around this that you can defer those capital gains, right, without actually paying the tax at that point. What happens is that once you have that deemed disposition, this is getting a little complicated. I don't want to go too much into it, but let's say after the 21 years, that 1 million, there's a deemed disposition. The 1 million now becomes the cost base, the adjusted cost base, which means that from that 21-year point forward, that's the new cost that will be used going forward, right? My recommendation here when you're planning for your trust, because of the complexity, is that you speak to a trusted professional, such as a licensed accountant. And I have CPA here in brackets. CPA is acronym for Chartered Professional Accountant, okay? So Monica, I know that was a complicated way to answer your question, but that's how it is. It's every 21 years that the trust is subject to tax. Okay, Monica?
Yes, thank you.
All right, perfect. So I just have this quick video that I want us to watch, and then I think we're gonna go over into our next segment.
I'm sorry, before you start the video, there's a part of my question that wasn't answered. So you said every 21 years we pay taxes on our will, our trusts, but when we put money or capital inside of the trust, do we pay taxes during the transaction?
No.
Or is it free of taxes?
No, it's free of tax.
So
yeah.
You only pay every 21 years.
Right. Or
okay.
if money is paid out to the beneficiaries.
Yeah, if something happens. Okay.
Yeah.
Thank you.
No problem. All right. So I found this video and I found it very interesting. It's called The Road to Zero Wealth, right? And I just want, it's about 11 minutes. If you get bored, let me know and we can stop watching it. But I think it's important for us to take a look at this video. All right, just give me 1 second here. Hold on. All right, can you hear the video? I know I've had in the past issues with people hearing. Can everyone hear?
No, we don't hear.
All right, we know what the problem is. All right, so I'm going to get to it 1 second. Who was that IT person that helped me the last time? You've solved a big issue for me that I've had over and over. So let's play it now.
If unaddressed, it's actually going to wipe out wealth for communities of color in less than 4 decades.
Yes.
That's the finding of a shocking new report called Road to Zero Wealth, How the Racial Wealth Divide is Hollowing Out America's Middle Class. Now joining us is one of the study's co-authors, Diedrich Asante Mohammed. He's a senior fellow at Prosperity Now, where he heads up the Racial Wealth Divide Initiative. Thank you so much for joining us today.
Thank you for having me.
So you really have to be blind to not see that America has a tremendous racial wealth gap. But talk about how you came to this conclusion that there will be zero wealth in communities of color in 2053 if things aren't addressed.
Well, let me first just to comment on your first statement that you have to be blind to not recognize racial wealth inequality, because that is true. That it's apparent that a good portion of the population is blind. There's been some recent reports from Yale and covered in the New York Times and Washington Post how white Americans feel that African Americans and Latinos are doing much better as it relates to economic equality than they really are. And so that's part of the reason that the report is put forward, is just to help give the true stats and highlight the reality of the great inequality that exists. So in 2013, we have some of the most recent wealth data. White Americans have a median wealth of $117,000. Blacks have a median wealth of $1,700, and Latinos have a median wealth of $2,000. And a big crisis, a big concern is that Black wealth has been going down since 2001. Latino wealth has been going down rapidly with the Great Recession. And that if we look over the last 30 years from 1983 to 2013, we see that there's actually a degrade of Black and Latino wealth. And if things keep going from the same way it has been from 1983 to 2013, we see that Black wealth we'll see a median Black wealth of zero by 2053 and a median Latino wealth of zero by 2073. And during those time periods, white wealth will continue to increase, though not quickly, but will continue to increase if things keep going where they have been between 1983 and 2013.
And so your first comment sort of touches upon how this racial wealth gap was created, how much of wealth in middle-class white communities was created through government housing policies that resulted in segregation and advancement for white communities that African American and other communities of color didn't have access to. And that sort of resulted, one of the byproducts of that, or one of the, not even byproducts, one of the intentional results of that is this dramatic segregation we see in our society, so that people don't have insight into how other communities are doing.
Yes.
Can you talk a little bit about that as well?
Yeah, I mean, I think there's a lot of myths out there that lead us to having a wrong understanding of how the world functions. I think most people don't understand that the country hasn't historically always been a predominantly middle-class country. That really arose building off of the New Deal following the Great Depression, and with the development of GI Bill and a very, very strong economy in the late 40s and 50s post World War II. And so, it wasn't until after these programs had been implemented and there was massive investment into a middle class that you see whites becoming majority homeowners for the first time and creating this broad, fairly prosperous middle class, which was a white middle class. Because obviously, when you're having policies in the 40s and 50s, even if at the federal level they didn't say that African Americans or people of color couldn't participate, they were implemented in a very segregationist manner. You had outright racial discrimination in the law, through the 60s. And so we had this massive investment in a time of legal segregation, legal racial disenfranchisement, which meant that the resources, and it's been estimated that more money went into the creation of the American middle class during this time period than went into the rebuilding of Europe after World War II. So we're talking about massive amounts of funds that went to and it was very successful. It created a very strong white middle class. And the challenge today is that as the population of the country increases to include more and more people of color, we're finding that the largest groups in these people of color, Latinos, African Americans, a smaller group, Native Americans, have never attained that financial security, which really is wealth, which allows you to be in the American middle class. And that's where we are today, with great disparities, even among African Americans and whites who are making the same amount of income. We see massive amounts of wealth disparity. One other thing I'll highlight is that even in terms of education, we see that whites with a high school degree make more wealth than blacks with a 4-year college degree. They have more wealth. So again, the disparities go up and down the economic chain for African Americans and Latinos, as well as the educational ladder. And
talk about some of the institutions and factors that continue to drive this increasing racial wealth gap today? We know, obviously, mass incarceration, unequal access to education. There's lots of different systems in play here, but what do you think are the biggest drivers of this?
Sure. Well, I mean, I think one thing it's important to note is that the economy over the last 30 years has been much more of a regressive economy. I mean, even for whites, you see a greater concentration of wealth among the top. Part of the challenge is, though, that even low-income whites have more wealth than the median wealth for African Americans. And so even in an aggressive economy, the white middle class is managing to hold on while kind of emerging Black, Latino middle class in terms of income is not finding that wealth stability. So there's an overall regressive economy that's happening. And then, I'll also put forward that, we spend over $650 billion a year in wealth and asset development. And that's a lot of money. And so we would think, well, this should be helping, those who are low wealth attain more of a middle class status. But the challenge with that $650 billion is most of that disproportionately goes to the wealthy. So we are actually investing in further concentration of wealth, and we're investing in maintaining and creating a larger racial wealth divide every year with the numbers of over $650 billion. So we could turn right side up this upside down tax system and make sure that wealth and asset development actually goes to low wealth communities instead of high wealth communities.
So we know that the Trump administration is the wealthiest administration in history. Heading these different, cabinet positions are millionaires and billionaires that have made their fortune sort of plundering the middle class, what you're talking about now. So knowing this, knowing that extracting demands from them are going to be difficult, what should these demands be that people should be organizing around now to address this?
Yeah.
All right. So I'm just going to stop there for now. If you would like, you can continue watching the video online, but I'll just stop there so that we can reflect on what was said in the video so far. Any reactions to what was said in the video? I know we spoke about this at length last week, right? And Michael was the one who initiated this discussion about where we were coming from and some of the systemic issues that prevents us from building wealth. Any reactions?
Yeah, Andre, Mike here. I hope you guys can hear me because I have really bad reception. But just this week, I made a presentation, and one thing I pointed out is that the richest Black person in America now, which is her net worth is treats white folks. The number 10 is Bloomberg, and he's at 50.4 billion. So even amongst our people who has created some sort of wealth, there's still a major gap.
Mm-hmm. Roderick, your thing is muted.
I would say just disappointed but not surprised. But also, like you cut before he said what should we ask the government, but what can we do, right? Because feeling disappointed is not going to fix anything. You can't fix it all alone, but you can only really control yourself, right? And he said what he said was really right. The Trump administration was the richest administration, and if they're rich, well, they have the rich mindset, and you don't get that rich without walking on top of other people, right? Well, with capitalism at least. So what can we do as a community to try to alleviate the pain? And we can't do it alone because we didn't do it to ourselves, right? So we do need like white folks and the government and everybody to go on behind us. But at this point, we got to lead the way because 2053, I'm like going to be what, 50? No, ma'am. No, ma'am. So, yeah, just that was really my question.
So the one basic fundamental strategy is collective action. So collective action is an accumulation of individual intent that's aligned So you recognize who else wants to achieve what you want to achieve. So this particular course, for instance, the folks who are on this course trying to upgrade their level of financial literacy, right? As much as you guys may not be interacting wholeheartedly with one another, you're all working toward, or we are all working towards the same end goal, which is some sort of platform upon which we can build wealth. That's number one. Then we have to look broader, as you said, and look at who are the allies that are out there. And you refer to them as white folks. It's white folks and others, right, who have a sense of human empathy for the impacts that we faced and the barriers that have been placed upon us in order to increase our wealth. Thirdly, we have to recognize these things consciously and say to ourselves, what is that end goal that we're trying to achieve? And it's Roderick and I train on anti-Black racism. We remind people all the time, Black people and people who are discriminated are fighting for equality, not to dominate anybody else, right? Really important to understand, it's equality. So what we have to do is start with the basic things like this, financial literacy, make sure we apply the knowledge. I sound like a broken record, but knowledge without application is worthless. It's a colossal waste of time. So anyone who's on, and obviously it's evident that those of you who are coming on this Flip, Floss, and Fly session consistently are intent on doing better, right? That commitment you're making to yourself is gonna have generational impact. Now what we have to do along with generational impact is have lateral impact. And Rod said it earlier, tell your friends. We've asked some people, and some people have done it, bring a friend to the next session so that the knowledge, as I said earlier, that you acquire and apply multiplies when you share it with others. And then we'll have at least these growing pockets of individuals who work as a collective on their personal efforts, but that combined effort for folks your age, if you're going to be 50 in 2053, right? You have a significant amount of time ahead of you, but the urgency is now because the urgency started before you were born. That's what we have to remember. The urgency started before you were born.
And if I could just add to that, Farley, and what that individual was giving was a forecast, right?
Yes.
So just like anything else in terms of the weather forecast, it can change, right? And it's up to us to change that. So if it sounds dire, and a couple people said it sounds scary and whatnot, which it definitely would sound scary and dire from my perspective also, but we can change that. And the more people that we have making, from our community, making solid investments, making well-calculated decisions, and as Farley talked about, working collectively, we definitely can grow our wealth within our communities and keep our wealth within our communities with just sensible decision making and investments. So we're glad that young people like yourselves and Jaden and everybody else who's on here are taking this information, and as Farley also just mentioned, incorporating it within your lives, right? So it's great to know it, but we need people to incorporate it, to put it into action, so that we're actually just changing our trajectory, not just talking about it.
Good morning.
Roderick.
If I can, may I say a few things, please?
Absolutely.
My name is Mona, and I really take my hats off to the young people on this call. Monica, I really appreciate what you said. We have to change the trajectory, and I thank BBPA what you're doing. A few points I'd like to share, and just a few quickly. Our young people are very tech savvy, and I would like to think that they can really take advantage of creating tech apps. Yes, you can. And there's a lot of money creating apps. Also into coding, get involved. Don't second guess yourself. You have the intelligence, you have the creativity, you can do it. We need to support BBPA and as a collective to strategize. I'd like to see BBPA sit, and I'm not sure what you do in your meetings, but strategize so that and incorporate some of the suggestions made on this call so that we can say, okay, we have done step 1, now we'll do step 2, step 3, evaluate and go further. But another thing I would like to suggest is that there are opportunities that some of us hear about but we don't do anything about. For example, I'm involved in Forex trading. I'm learning currency trading with a company that have us earn, that we have opportunities to earn while we learn, and we can capitalize on the international market. And so I wanted to send a recording of a presentation to Farley or someone in BBPA, but I didn't have an actual, it's a 20-minute thing, just so that you can look at it, see what you think, and then perhaps share on a call like this. Other people are taking advantage of it. Last night I looked at a call with so many young Blacks from the States, different countries, who are doing so very well. We don't guarantee anything, just like you know, but the education, you guarantee that you will learn because you will put the effort in, and you guarantee that you'll involve other people. You can guarantee that because you can involve a sister, a brother, and don't stop until you get at least 2 or 3 people involved. Just have that mindset going forward. So this one says no, big deal, next. This one says no, big deal, next, until you get where you want to go. Because people are doing well in it, and we should take this opportunity to capitalize on it. Thank you so very much for listening.
Thank you, Mona.
Thanks, Mona.
Thanks, Mona. So Andrew, may I speak?
Sure, go ahead.
Okay, I just wanted to remind the younger folks that the forecasts about 2053 are going to zero. As Roderick said, it's a forecast. Because remember, the last time in this part of the world when we were zero wealth was in 1838 in the Caribbean and 1865 in the Americas. We were at zero wealth at that turning point. And now we have gone ahead of the game and we've got people who are billionaires and so on. So it's doable. And by way of a practical example, we should start to spend a little more money in the Black community, ensure
100%.
that the turnaround is more than 1 or 2 or 3. That is how we can practically start with ensuring, the wealth. And as far as say, we're not trying to get predominance. We just want our right at the table. So when we say spend amongst our community, we're not saying don't spend amongst other community. We're just saying that that's what other communities do. They spend amongst themselves and grow their wealth. And that's a good habit to adopt. Spend amongst yourself and grow your wealth as well.
You know what, Michael? That speaks to the old adage that charity begins at home. Many of you have heard your parents say that, right? And that's not selfishness. That's about self-sustenance. So what we have to ensure that we do is recognize that as solid as we can be, or the more solid we are in our homes, the more stability we have, that we can take calculated risks to help others at the same time. So I wanted to say also that there are several efforts as we speak right now in this country to bring things like a Black bank, a chamber of commerce. There are a couple of different efforts along those lines. What we need to do, as Rod and I preach over and over and over, is function as a collective so that things aren't siloed and we get rid of the affectations of colonization, like the whole crabs in a bucket thing. Oh, I don't like this guy, that guy, all those petty things. I heard somebody talk about an artist yesterday, a Black person talk about a Black artist that they don't even know. I've never heard white folks talk about a white artist, like saying, oh, that guy is then, like, we got to get rid of these minor things that become pervasive in our community to hold us back, right? We're trying to move forward. So being held back is the antithesis of our objective. We have to be really, really mindful of that. We have to move forward, and moving forward as a collective, we call it ants moving a leaf. If you guys go into the forest and watch some ants move a leaf, if there are 5,000 ants, it's not 2,500 and move the leaf and the other 2,500 say, yo, text me when you get there. No, it's seriously, it's all of them get under that leaf and move it together from point A to point B, and then they build a home together. Or they build whatever apparatus it is they're building together, right? So this is what we have to recognize. It's a major flaw in our, what I call our learned DNA.
And I think just by saying that, Farley, sorry, go ahead.
And may I add, Farley, they move the leaf timely.
Absolutely.
And patient. So, you want to give people hope, because when we hear about this daunting report, you said, oh my God, when are we going to get there? But with strides, time,
right,
purposefulness, discipline, they get that bloody thing in that hole. And you go back next day, you see them not running, same pace. Everybody
Great point.
Yeah.
Good point. Yeah.
Great point, Marlene. Very good point.
All right.
And I think it also says that we have to do some relearning, right? I mean, obviously, this is a great example of relearning and coming up with a different narrative, not just for today, but for tomorrow and days to come, right? And what we've learned in the past, if it doesn't work, it's insanity if we think it's going to, if we think it's going to work in the future, and we've been trying something over and over and over again, and it hasn't worked, it hasn't gained us any wealth, it hasn't, improved our chances of, leaving some of our circumstances in the past, we've got to try something new. And again, that is where we have to challenge ourselves, folks.
Yeah.
And, when we see some of the disturbing narrative, or we hear some of the our friends maybe talking negatively, we got to put an end to it, right? We really do, because at the end of the road, if it's not going to benefit us, it's going to put us behind, and we cannot afford that. We've been resilient, but now it's time for us to exude our brilliance, and we deserve that. There's nothing in this world that says we cannot be brilliant and succeed and be successful in everything that we do. So we've got to put away that negativity and step into that positivity, and it's gonna be difficult, but that's where we have to challenge ourselves. That's and it's gonna take courage.
And for example, for a session like this, we want to see it continue, not just a one drop here.
That's right.
Yeah, this is just the
Everybody
this is just the
do the one
beginning.
drop.
No one drop. No,
No one drop. More than one drop.
I'd just like to say,
we want to celebrate and highlight Andre's talent and spread it and make it big so that other cities or wherever communities can benefit. And the more we hear it, Farley and Roderick and Andre, the more it's a cement in our minds that, not just this one session when it is over, September, October, I don't know, but continue, get, let's spread the word. Let's do it.
This is going to be, like, right now it's becoming a staple on Saturday mornings, and we call it Saturday morning school.
Yes,
and,
the Jews have them Saturday morning school. Yeah, we need our Saturday morning school.
Right, people go to Sunday school, this is Saturday school. 100%.
Yes.
Good afternoon. Good afternoon. I'd just like to say hello.
Yeah, go ahead.
Yeah, I'd just like to say, as I walk my son here this afternoon, we need to be aware of our values. And if we're all aware of our values and we value that our Black people will need to be uplifted in this way of financial literacy, that will drive us to do the things that are necessary. If you value your son being educated, you're going to do things to make sure he gets to the higher education, right? So if we're all just aware of our values in life, what we are set out to do, I think that would be a great justice towards the whole pact, I guess.
Yes, and I think also that one important thing is to recognize that our history began centuries upon centuries before slavery. What happens is when we dwell on a negative start, it's very difficult to come out of that from a consciousness or from a consciousness standpoint. Let's recognize that the brilliance that Rod spoke of already exists within us. It's like muscle memory, right? If you know how to work out or ride a bike or swim or whatever it is, and you take a long time off, the first few seconds, you're just getting back your balance and all those things, but your muscle memory comes into fruition and you start riding straight, swimming more effectively, whatever it may be, right? So we've got to dig back and remember how great we are, what the contributions we've made to this planet have been, right? And start there. Don't start with being behind. In 1865 or in that decade when the right to vote was first given to Black men, we saw some progress based on equality. The right to vote, although there were many efforts to suffocate it and eradicate it and limit it and so forth, but it was the opening of our sense of inclusion in North America, right? Especially in the United States. But we got to go a little further back and recognize the greatness, which is where those values that the brother just spoke of came from. Values that other cultures took, like literally borrowed from us and made their own staples in terms of values and in intelligence, technology, all the things that other countries and people are identified with, the majority of them came from Africa. Straight goods. Do your history, right? So let's try to be a little more positive about the outcome in terms of the fact that we were already there, right? Let's not start with where we weren't. Let's start with where we were.
Yeah. All right. Amazing. Thank you so much, everyone, for sharing. And the 3 words is to build, sustain, and transfer wealth. So as you think about financial literacy and money, think about those 3 words, right? Because that's how we're going to do all these things that we're talking about. So we're going to move into our next segment, and we have a guest speaker today. His name is Kino. He's a financial advisor with Expere Financial Group and the co-founder of Oceans Group Investment. You know, one of the first questions, and Kino and his partner can tell you, is that my first question to anybody that I work with is that I ask, are you doing this for profit, or are you doing this for the benefit of the community? And that's really one of my fundamental vetting questions, because at the end of the day, this program started by Farley and Roderick and the BBPA is all about building our community. And so without further ado, I'm going to get Kino to talk about insurance. So he's an expert in the field. So Kino, if you can come on, and I'll go through the slides for you.
Okay. Hello, good morning. Good morning, everyone. Thank you guys very much. You know, from, you know, myself, the BBPA, sorry. Thank you guys very much for having me on. And of course, Andre, I've been following the program extremely well. You know, on the topic of, you know, insurance, insurance is a complex topic because there's so many different types of insurance. Can you guys hear me, by the way?
Yes.
Oh, perfect. Yeah.
Loud and clear.
Sorry?
Loud and clear.
Oh, perfect.
And if Michael can hear you, everyone can hear you.
All right, perfect. And you know, I wanted to thank you guys for having me on. But as in terms of insurance is a complex topics because there's so many different types of insurance that does so many different things. I know today I basically focus my attention to life insurance. And on that, I focus my attention to the 3 main type of life insurance that people, when it comes to financial planning, what people mostly, you know, think about, focus on what they have. And, you know, some of the individuals on the call may have some of these as well, but there are different types of insurance. You know, you guys know there's life insurance, there is travel insurance. So life insurance is, of course, you know, someone dies and that benefit is paid out, right? Or, you know, we have as well living benefits, living benefits that people would basically, while they're alive, they will actually get an insurance that will help them in the offset, you know, they get ill, anything like that. There's also, you know, your disability insurance. A lot of people, you know, overlook these type of insurances for many reasons, and that could be just because, you know, they have employment, and you know they do get some disability through that. And I know, Andre, I'm talking off the slide. Just give me a moment.
Yes, that's cool.
Okay, I know you're probably wondering I'm not talking on the slide, but give me
No, that's fine. You're the speaker.
Okay, perfect. So, you know, there's disability, there's health insurance as well, right? There's auto insurance. You know, most of us that are driving, well, all of us actually, have auto insurance. If you don't, there's an issue, right? So, you know, auto insurance is mandatory. So everyone has that that are driving. There's also home insurance, and you know, as the topic of home insurance goes, there's different types for that as well. So today I'm just focusing my attention to the life insurance part. Mainly, you know, the 2 main types of insurance, which is term and permanent. Okay. All right. So insurance, you know, just like a will, it is basically a contract. It is a contract. And it's a contract that you signed between the insurer and the insured. Now, within that, there is the insurer, who is an insurance company that basically issued the policy. And then there is the insured, which is the life that is being insured. All right. In that as well, there is the premiums. Premiums is the amount of money that we pay per month or per year for that particular insurance. And there is also the claims, right? But there's only really two parties to the contract. There's the insurer, the insurer, the insured, or the policy holder. They don't necessarily have to be the same individual, but yeah. Okay.
All right.
Yeah. So, when we're talking about insurance, guys, we're talking about risk management. All right. Insurance is really for, mitigating some risk, all right, or risk that we foresee. Risk, people deal with risk differently. All right. So right here on the slide, I have a few ways that people deal with risk. Some people will avoid it, right, which some people do. They don't take out a coverage because they believe that either, they don't need it or they can't really see the risk associating with not having it. As well, they ignore it. They reduce it, all right, and they transfer it. Now, insurance is one way to transfer that risk. That is taking off the, back in the days, they used to say, to pass the hat, right? What it is that they basically give the opportunity, they put off the risk of the financial burden that would normally be placed on families and basically put it towards the insurance company. Now, a lot of people think about insurance, associated with debt, right? Yeah, people think about insurance associated with debt. They, they think about it as a financial security. They think about it as a peace of mind, right? And they think about it as a safety blanket. So insurance is basically, it can be made to basically, tailored in any way to help any individuals in whatever situation they may have. All right. So a few things to consider when thinking of insurance, right, is, do I need life insurance? How much do I need? What kind should I buy? All right. And these are very important questions because these questions will determine, first of all, that the fact that we're asking the question is to say that, we actually know that we might need it, right? How much do we need? A lot of, back in the days, a lot of insurance agent would normally just sell an individual a policy. But now within the industry, there is, you have to be compliant. There is compliance where you have to now take a financial analysis of that individual, right? What's their actual need? So the rule of thumb normally is that you need about 10 to 20 times your annual income. We need to do a financial analysis, as I said. All right. Now, a financial analysis is in-depth analysis of an individual financial needs. That takes into consideration income, purpose of the insurance, as well. It takes into consideration your assets, your dependents. It's all about the purpose of why we're actually getting that particular insurance. As well, insurance is used for many reasons, as I said before. It's used for retirement, for funeral expenses, uncovered medical costs, right, that you know, the government and our health system may not cover, mortgage and other debts. All right, it covers taxes and probate fees as well. You can use insurance for, you know, estate settlement costs, college education, a wide variety of different things that insurance is used for.
I have a question.
Go ahead.
What is a probate fee?
Well, the probate fees is that fee, and I believe Andre went over a little bit about probate. It could be, you know, the fees that we pay when we pass away. When we pass away, the government basically, you know, look at all our assets, and there's a fee associated with that. I know we pay our taxes, but the probate fees is also paid within that.
So just to add, Monica, so as part of the estate planning and creating a will, so once you draft that will, so all your assets and liabilities, they go into the will. And so when that person dies, in order for the asset to be divided, it has to go through a process called probate, right? And just like Kino said, they're going to take a look at all your assets and then divide them among the people who should benefit. So there are fees associated with that, because you will need lawyer and costs to do administrative things, right? And those can be very expensive. So having an insurance specific to that purpose could help cover those costs and ease the burden off you and your loved ones when that person passes away.
Exactly.
Are we good, Monica?
Oh yeah, thank you.
Okay.
Okay.
All right. And so as sorry, Kino, but as you can see, so it's important. I think this question came up in the last session because we were talking about people passing away and leaving a lot of liability, so money that they owe behind. And as you can see, it's important because you know, when you if we don't plan for unexpected events, then our loved ones are left with the burden. So it's important to plan. And just before we move on to the other slide, Kino, like, can you just tell us like how having insurance, like within our community, how does it help to build, sustain, and transfer wealth? As we are talking about insurance, why is it really important to have insurance?
Okay, perfect. So thank you, Andre. So insurance is a big part of financial planning. That's because with insurance, as I said before, that we use it for all different reasons, you know, as you can see on the screen here. But one big thing is that, you know, we have no control over, you know, our mortality in the sense that we don't know when we're going to pass away, right? But what we want to do is that because we have a goal, just like, you know, we talk about, we budget, we're saving, and we're saving with purpose, right? When we're doing these things, we want to make sure that at the end of the day, you know, how we save and what we're saving for, we meet that particular goal. Now, you know, like I said, we have no control over our mortality. We might pass away at any day. I can get up right now, go outside, take a drive, and, you know, I pass away, right? But at the end of the day, I wanted to make sure that my children, you know, your family that are going to be left behind, you know, are taken care of. And that could be, you know, as well looking at, you know, children education. Right? How do we, you know, we're not here anymore. So insurance is a good way to set up ourselves to say, just in case we are not physically here, the purpose and the goal that we have, that proceeds that come from the insurance company will be able to take care of that particular goal. And the conversation about how transferring wealth, you know, there are, you know, and we're going to talk about it a little bit, whole life insurance and participating plans that will be able to build up a substantial amount of you know, debt benefit that just in case of something happen, you know, that money is going to go towards the our family member as well, because that money, it could be a large sum, when it goes to our family member, it is tax-free. And, you know, at the end of the day, that's something that we want. It doesn't go through probate. It doesn't get taxed. So, you know, that's how it will be able to help and is helping our community.
Good. Thanks for that.
No problem.
Always good to earn money tax-free.
Well, you know, that's definitely a strategy that we use insurance for sure. You know, and I'm going to keep going through the slides, but definitely, you know, if someone have a question, please ask. I know I'm kind of skimming over the insurance topic, but like I said, it's vast. It's going to take time to actually go through everything. So definitely ask question if you do have, okay? So there's two main types of insurances. Jay?
Am I going too fast?
Yeah, you're going too
All right,
fast.
cool. Here we go.
Okay, sorry. So there's two main types of insurances. There's when we're talking about the life insurance, there's the term life insurance, and there's permanent life insurance. All right.
So what's the difference between the two? Like what you say is term and what is permanent?
Well, term life insurance, and I think it's in the next slide, but term life insurance, yeah. Mm-hmm. It's basically, you know, it states what it is. It's term. It's for a period of time. Now, it's the most popular insurance out there, you know, the most common that people will have. It's also the lowest cost of insurance. You know, we could have a set period between 10, 20, 30 to age 65, you know, and then that term will end. It's a good temporary solution in terms of, you know, your mortgage, individuals that out there have mortgages and you wanted to cover that liability, then you can use a term life. And term can be basically broken up into many, many, many ways. You can have a term life that is decreasing, meaning that just like your mortgage or your loans, you know, you're paying it every month, you know, every year. So that amount, the principal that you owe goes down. The same thing with you know, a decreasing term insurance. You also have, you know, policies that increase in benefit as well that we're going to talk about. But for term, it's just the most popular insurance out there. And it's, as I said, just for that particular set amount of time that is basically concluded in the contract. So it is basically cheaper in the earlier years, but as we grow older, like when we have to renew it, it's going to be more expensive. So we also have whole life insurance, right? And whole life insurance, you know, that could be broken up in many ways as well. But normally, whole life insurance, you can have a non-participating policy. That means that, say that you, you know, take out a policy for 100,000, it will be 100,000, 50, 60 years from now. It will stay the same. So it's a level premium, meaning that the money that we pay per month or per year stays the same all through the policy, you know, but the death benefit does not increase. We also have a participating plan, you know, which is also a part of the permanent insurance contracts. And in participating plan, the reason why I like this particular plan is because the death benefit grows over time. Say that you start with 100,000, you're paying a set a premium. That premium is going to be level, meaning stay the same all through the plan. Now, the death benefit does increase over time. And that's because they're a part of that premium that we're paying is going to be going into investment products. There's also dividends that will be going into you know, the policy as well. So the death benefit grows. You know, whole life is, as it says, it's for the rest of your life. All right. So, you know, when we're talking about estate planning, when we're talking about, you know, transferring wealth, right, we normally use a whole life rather than a term because we don't know when, you know, like I said, we're going to pass away. So, you know, we normally say that, you know, you have a policy up to age 65. After 65, that policy is gone. So you won't be able to, if you live past 65, you won't be able to transfer that wealth. So we use whole life in that particular strategy. So the premium you pay, like I said, it goes, you know, to investments, you know, that is managed by the insurance company, and, you know, it grows, right? So you can flip to the next side.
Hello?
Hello?
Hi, I'm just going to chime in for a quick bit while I can here.
Yes.
And it's Earl Anderson here. So I remember, Kino, I just heard you talked a little bit about as you get older, the rates go up. So that's an important factor when Andre, when you're talking about building retention and growing wealth in the community too, right? So obviously, we all want to make sure that we practice starting young and teaching our next generation and our present generation at a very young age how to sort of manage wealth and money. And when it comes to insurance, it also works in the same way too. So the younger you start on a particular product or solution within the insurance industry and financial industry, it also it's a lot more beneficiary for them in growing the wealth aspect as the cost is lower, and as they age, it's sort of locked in at a particular rate. So that's, I just wanted to
that's a good
quickly
point. So
mention that.
let's say I start this whole life insurance for my son. I have a son that's almost 2. Can I transfer, let's say by the time he reaches 18, can I transfer it from myself to him? Or like, how does that work?
Yes, you can. The policy holder or the owner of the policy, you can transfer that policy over to pretty much anyone you want. Yeah.
Okay. Good stuff. All right. Thank you. Thanks, Earl.
Yes, thank you very much, Earl. And, you know, that's a good point as well when it comes to insurance. You know, there's a few factors that affects, you know, because a lot of people, when we're talking about insurance, they associate it with, you know, expense, right? It's just an additional expense. They don't see the point. But when we're talking about, you know, keeping that premium down, you definitely want, there's a few things that affects that. The things that affects that is age, as Earl said a while ago. You know, the earlier is the better. It's just the way it is. There is also your health, right? The health condition of a person affects, you know, what their premiums can look like. You know, it could increase it substantially depending on their health situation. As well, you know, their work and occupation can affect, you know, the premium as well. You know, so there are various things that affects insurance premiums, the rates, how the insurance company view, you know, their risk to giving out that policy. So we definitely want to, you know, look at those things. As well, I wanted to say that, you know, just like we don't know when we will pass away, we don't know as well, you know, when we will fall sick, you know, what our health condition is going to be in 5 to 10 years. So that's why, you know, the younger, the healthier, the better.
Good stuff.
Yeah. So I also wanted to touch on this particular insurance as well, which is universal life. I know it's not the most popular insurance out there, but just like every single insurance vehicle, they're all important, and they're all important for different reasons. It all depends on the strategy, that we're using it for. So universal life is the same as it's the same as a permanent insurance. It could, I would say, yeah, same as a part plan, because the only difference is that the universal life, the death benefit, it's not basically, it's not guaranteed, is the word I'm trying to find. The reason why is because
So sorry, the death benefit is not guaranteed for which one? The permanent?
Universal life.
The universal, okay.
Life. Yeah, and that's because sort of amount of the premium is going into investments, is going into the market. Now, we know that the market fluctuates, and sometimes, well, especially we see what the coronavirus has had, the impact on the market. It goes up and down, and the decline could be severe. So it can have effect on the actual that benefit, but it was just made for individuals that have a long time before they really need that investment. So say that you open this policy and you open it for 20 years, right? So you have and that's one of the things I wanted to point out as well. For participating plan for whole life, you can actually set the payment for the actual policy for 20 years, 30 years, to age 65, to age 100, right? It all depends on you. So it's the same thing with the universal life. You can actually use this and pay into it as a tax sheltered for a tax sheltered gain for the investment. But the only thing I would say for this one is that that benefit is not guaranteed. Now, it is permanent. It lasts for the rest of your life. The premiums, as long as you're paying the premiums for all the insurances, it combines the advantage of permanent lifelong policy with tax advantage investment components. So basically, part of your money is going into a investment, right? Just like a participating plan do. Now, it's flexible, and that's the reason why this insurance is sometimes the strategy, depending on the individual. So say that your income is not steady, it fluctuates. This could be a solution for you. Because there are minimum and maximum that we pay in a universal life policy. So sometimes you can actually pay the maximum that will inflate the death benefit, inflate the investment portion of the policy as well. But the only thing is that once you're paying into this policy, you can increase and decrease your payment in a term. There's no flexibility of that. And in a whole life, there's no flexibility of that. Okay, so it lets you select your preferred premium schedule, select amount you want to pay within limits, right? So like I said, there's a minimum and a maximum amount that you can pay to keep the policy in force. It's an investment that matches your unique risk profile. So, for these insurances, we do like a risk profile, just like we would if we were investing.
All right, good stuff. Do we have any? Thanks for the lovely presentation, Kino. Do you have any questions for Kino?
Yes.
Or myself?
For Kino, I do have a question, and I know there's a question in the message box as well. But okay, so my thing is, especially what's going on in society and how the economy is going low, what can you encourage young people like myself to start off with basic and simple ways to start off like life insurance? Because different insurance. There's life insurance, there's car insurance, and there's other types of insurance. But what's like a benefit, simple way, especially if they're, like, for example, they're living on their own and they're starting out on their own and it's from scratch, and how they can budget around that.
Okay, so that's a perfect question, actually, because when we're looking, you can actually, I would say personally, because it all depends on the person, and that's why I put in there the financial analysis to see the purpose, the income, you know, what's your goal for the insurance. But normally, typically, you know, especially with individuals that don't have dependents, you know, we normally say, you know, a term would be a good way to start, because it's very affordable. You know, especially if, you know, around 30, 35, you're looking at maybe, you know, between $15 and $25 a month for a policy. So, you know, and that would be like a part of, you know, your budgeting system. You know, just like we pay for, you know, our car insurance and stuff like that. I would say definitely budget that particular, you know, part of the strategy in there as well. Because at the end of the day, we wanted to make sure that for those that don't have dependents, they don't have a spouse, they don't have a partner, so the financial strain won't be on those individuals. But, you know, we do have parents, we do have, you know, parents that are going older, we do have grandparents. So definitely an insurance product would definitely be good for all type of reason. Yeah, I hope that answered the question.
Yeah, thank you. And then I have another question. In terms of maybe the gentleman, also the host, can help me with that question as well. But in terms of how to invest, right, for like young entrepreneurs, if they're starting out their own business, but also for their future, they're because starting a business is also investment, but also even just investing in like a land, or investing in gold and silver. Can you explain on that, just to prepare for young people for their, you know, their future?
Well, I'm gonna let Andre jump in.
Yeah, and I mean, there was actually, we had a series on investing, and we talked about investment in land. So land would be an asset that, for the most part, appreciates in value, right? It doesn't go down. So it's usually a good investment, especially if you buy a piece of land in an area where there's future development. In terms of a business and investing, so you're a business owner, you know, as your business grows, you want to think about ways that you can invest more in your specific business, as well as acquiring additional businesses, right? Because especially in the community, you know, it's important for us to know that we don't have to start everything from scratch or reinvent the wheel. So if it is that there's some business that is in, you know, similar line of business as your business, or completely different, you can acquire those business or form alliances with these businesses, right? So you can become part owner in those business. Another potential way that you could invest is in the stock market, right? So, I mean, right now the stock market is pretty volatile, but if you know things like options trading, you can hedge against those risks, right? And the volatility in the stock market. You know, buying stock is a great way. There are different strategies. You can invest for the long term or the short term. But like I said, there's a series on that, and it will be important to watch that webinar series. But there are a lot of ways that you can potentially invest in the and to make money, right? So land, stocks, acquiring additional businesses. You just have to be creative in terms of your investments.
And then also, like, it's in the BPA, right?
Yeah, bbpa.org, and it's on the programs, I believe. The link was in the chat. Someone sent it in the chat. So you can see the videos there.
And also, like, what about, like, because I was talking to someone the other day, and they were saying that with how everything is going, like, people are going to eventually have to stock up and invest in silver and gold. So, like, what could you say about that?
I mean, you know, and just like, there are always a scare tactic in the market. I generally, for my portfolio, I don't respond to what people are saying. I do my own due diligence and based on my personal scenario. So people are forever going to say things. It's just like we said about that video, that people are going to forecast and people are going to make scare tactic. What you'll understand in the stock market or in investment is that there are people who are influential, who will scare people into thinking certain things so that their investment portfolio will work the way that they want. You have to go back to yourself and ask what you want specifically and make your investment decisions based on your goals and objectives and your due diligence. So don't try to react with what other people are saying. Look at your specific objectives. All right? So in the interest of time, we've gone over about 11 minutes over or something like that. It was a great discussion. And I really love the engagement and the participation. Again, we want to encourage you to bring a friend and let that friend, bring a family member. Please, we are asking to raise the numbers. We want to reach as many people as we can in the community. You know, this is about building financial literacy. It's about networking. There are so many intelligent and amazing people on this platform. I've had multiple people reach out to me on LinkedIn, Facebook, and even calling me, right? So feel free to network as much as you can. Reach out to the BBPA if you have any questions or, you know, you need something clarified. If needs be, they'll probably refer you back to me. But we are here to help you guys. And I have another beautiful quote here to wrap up our segment. Your assets are your employees. Invest more on those performing well and let the non-performers go. Now, I want this to be applicable to two aspects of your life. Your assets, let your asset work for you. But also, it is important that we evaluate people within our circle, right? To look for the non-performers, right? Sometimes we may have to let those people go, right? And for me, I generally let people go, not by telling them that, hey, I'm not talking to you anymore. It's just that I'm more careful about how I spend my time. And it may not be spending a lot of time with certain people, right? So we are here to share, we're here to learn and to grow and to challenge ourselves to do better and to be better. And so that's it for me. I don't know if anyone else have anything that they want to share.
Absolutely, I do, but I think Michael had something he was going to say.
Yeah.
Oh, sorry. I just wanted to support Andrew by saying 10 years ago, they were projecting that the price of oil would have been $400 a barrel. And a lot of folks were buying up oil futures. And now it's struggling at about $12 a barrel.
Mm-hmm.
And it has never gone beyond $100. So you have to do your own homework.
Absolutely.
I just want to thank Kima for coming on as an expert in his own area. It's really nice when we do have the experts in a specific skill set coming on. I love the insurance delivery.
Perfect segue, Michael, because I have a small challenge for Andre. He made a comment about Susu a couple of weeks back, and I've got a Susu expert who's going to be coming on the show, right, to give us another perspective on how Susus can be used effectively as an African originating financial literacy process. I'll call it that. I just created that right now. Financial literacy process. There you go. So don't bite that, Andre. Anyway, yeah, so Janelle Scarrett has agreed to do it. I haven't confirmed that it will be next week yet, but I think it's important for folks to get a sense of how historically people, including my mother and my sister, who have their PhDs in susuing, if that's a term.
Are we going to have our own susu?
Maestro. It's maestro in susu. Maestro.
So are we going to have our own?
No, we're not. No, I'm just having somebody come on who can talk about an aspect of that model that is a little more evolved than we all might be aware of, that actually established companies today still use.
But why we don't have one?
No, I'm not saying we won't, but I don't want to speak out before we have a plan. Okay,
yeah,
so
okay.
yeah, we can talk about that. And you can certainly chime in when the presentation is being made if you have some ideas and thoughts. This is all about a collaborative effort. So we want to make sure that everyone has a seat at the table, if you will. So yeah, with that, I think we should close off for today. I wish everyone a wonderful weekend. As you all know, you all have an open invite to attend Toronto Shines at Ontario Place, the project that I work on on the entertainment side of my life. I remember that Say It Loud, the project is alive and well for young people, entrepreneurs, technologists, people who have social innovation, innovative ideas, socially innovative ideas, etc. Visual, culinary, fashion and performance arts. So yeah, we're doing lots of things in partnership with the BBPA, in partnerships with Brandy Q, with Andre, and many other Black-owned and operated entities, as well as larger corporations. So with that, everyone have a wonderful weekend. Thank you for your commitment. I'm going to emphasize again, bring a friend, tell a friend, and show your face. If this was a meeting at Andre's office, you would not wear a plastic or a garbage bag over your head. You would show up, you'd be ready. You know, have your family see you getting dressed for Flip, Floss, and Fly Saturday morning, because you're going to a meeting. You literally are. So we need to show ourselves and represent who we are. So that, what if I run into you on the street and I don't know it's you? You know what I'm saying? The opportunities are missed when we hide behind things. Okay, I just want to encourage folks to do that. This is a safe space. I think we've established that. So no reason. If you need to brush your hair backwards, sideways, forwards, do it. Right? Brush your teeth, do all the stuff Marlene's smiling at. Marlene loves that kind of talk. Marlene, why don't you close us out today? Why don't you give us a little closing statement?
Oh yeah, thank you so much, Farley, for the opportunity. And as a mom and a grandma, I'm stepping up to the plate to make sure I leave this. I encourage my children, my two girls, to be more aware of, you know, how to plan, because what did they say? If you don't plan, you plan to fail if you don't put a plan in. So thank you so much. Yes, you plan to fail. Thank you, Farley. And I'm learning too. One of the things I really learned, Andre told us about, is in the will planning and the mortgage, and how to navigate spaces. So thank you so much. And my desire, as I told you, I always tell Farley, I like to see plan in action. So, like, you know, when you talk about the SUSU and some investment thing going on for this particular, the first of its kind, I'm seeing, let us set precedents that we did something, we put something in place and it's working, so others can come know that. Because our culture, we like to see result. We're result driven. If we don't see it working, they don't want to jump in. So we want them to jump in, right? Stimulate jealousies, good jealousy. There's good jealousy and bad jealousy. Stimulate it so that they can be okay, the good word is create the hunger, so they come in and start drinking and eating and participating to a collective. So thank you, Farley, and may God bless everybody, and we'll see you next week.